Hi, I'm Amanda Morale with interest.co.nz. I'm here today with a double shot interview with Carmel Fishers, Managing Director of Fisher Funds. Hi, Carmel.
Hi.
Thanks for taking the time to talk to us.
You're welcome.
Carmel's going to talk to us today about various Kiwisaver issues, but Carmel, I'd be interested to hear your thoughts about the earthquake. It's obviously going to have a huge economic impact on this country. Any indications how that might affect investments?
Look, yes, I mean, it's early days, obviously. It's unfortunate, obviously, that it's followed it's the second earthquake, and investors have, over the last 6 months, tried to assess the impact of the first earthquake. This one's obviously even more significant. I guess that it will affect investors in terms of New Zealand overall. It will impact our economic growth because the country's reserves need to be used to rebuild Christchurch. So that will have implications because New Zealand was already going to struggle to achieve the sort of average growth levels that it has in previous decades, and I think this is just a bit of a knockback. The share market has already reacted quite specifically and pushed up the share prices of investment of companies like Fletcher Building, because obviously there's going to be a lot of rebuilding work that Fletchers will benefit from, and then it pushed the price of Tower down because of all the insurance claims and so on. But I think it's early days to really quantify the impact. But overall, I suspect it will be negative as the rebuilding process goes on. But then longer term, that may actually be positive because it may, when the growth returns to Christchurch, obviously that will lift the country's growth overall. So it's quite an imprecise thing, but there is going to be an impact, I guess, is the bottom line. Yeah.
You mentioned just before we came to do this interview that one of the companies you invest in, Ryman Health, has been badly affected in Christchurch.
Well, we don't actually know yet, and so immediately after the earthquake, the Ryman Healthcare price fell because their head office is in Christchurch and they have retirement villages in Christchurch. Yeah. I expect that we'll hear from the company shortly as to the extent of the damage. Look, it's just awful. You can't really read anything into the short-term share price reactions because it's like all of us. We can't think about much else actually, and you can't quantify. And it's wrong to even try and think about quantifying it at this time. The impact we'll find out about it later on.
Okay.
It will unfold. Yeah.
Is it just more caution though about paying close attention? I mean, that's something you do anyhow by the sounds of your management style. You do a lot of research and investment and follow up.
Yes.
Does this drive home the importance of
Well, look, yes, but we're not going to suddenly revisit all of our companies and say, well, we won't hold them in the portfolio just in case there's another earthquake in Christchurch or Wellington or wherever else the next one might be, because this is a random hopefully one-off event, and you can't analyse for all of these external factors. You can't analyse for Mother Nature, really. That will be what it will be. I guess the way we try and cope with these sort of external events is to make sure that we have a diversified portfolio so that we have companies in different sectors and different geographies, so that even if one or two of our companies are impacted, and hopefully that those impacts will be short-term rather than long-term, then hopefully the overall portfolio will still sustain and go on to achieve growth.
Okay, so no knee-jerk reactions at this stage?
We are not knee-jerk investors, no.
So maybe now is an appropriate time to describe your management style. You've been described as a growth actively managed fund manager, and
That's right.
You invest on a buy and hold strategy, and you have bias towards small New Zealand companies.
That's right.
Does that apply to your Kiwisaver funds as well?
Yeah, yes, it does. All our funds are managed. The Kiwisaver fund is made up of all of our individual funds. So a Kiwisaver investor will get exactly the same investment portfolio as an investor who comes to us with $50,000. So in our Kiwisaver fund, we have New Zealand shares, Australian shares, international shares. And in our conservative Kiwisaver, we have some infrastructure and fixed interest. So our stock picking style, our favourite companies are our favourite companies, regardless of whether you're a $100 a month investor or $50 a month investor, or whether you're a $3 million investor.
I note that you've been nominated the People's Choice Kiwisaver. You've got really great information on your website for people to follow, and it's quite nicely laid out for people.
Thank you.
It's a complicated area though for a lot of people, particularly those coming or investing for the first time. What are the challenges in I guess making that kind of information understandable to general audiences, and how have you managed to try to
Look, it's
overcome
always
it?
been a really important focus for us. Our mission statement when we started the company 14 years ago was to make investing understandable, profitable and simple. And to make it understandable and simple, you need to communicate in a way that people can understand. And for a lot of investors, they've been scared of the share market, haven't really understood it, thought about it as being a casino, whereas they can understand fixed interest and they can understand property. So we've really spent the last 10 years plus communicating in a way that they will understand. And the way we've done it is to actually talk specifically about the individual investments in our funds. So rather than just saying your fund has gone up 1% this month, aren't we clever? We've said your fund's gone up 1% this month because of these three stocks in particular, and these three companies, this is what they do, this is why their share price went up, they announced a good profit result or they announced an acquisition or whatever. And so after a period of time, every investor with Fisher Funds will have a pretty good idea of where their money is invested and what sort of companies and why we chose those companies for them. And so then if they read in the newspaper that Pumpkin Patch has had a bad profit result, they're less likely to panic because they understand why we bought shares in Pumpkin Patch, and they also understand that Pumpkin Patch is just one of 15 different companies that we invest in New Zealand, and then we've got another 25 in Australia and another 30 overseas. And so they feel, because they've been told about these companies, they feel more empowered, they feel more engaged with their investment. So we've always tried to communicate simply but comprehensively and candidly. When we lost money, when our funds fell in values quite significantly in 2008, we fronted up, we went and explained what had gone wrong, and I think investors appreciated that.
You've said you try to operate in an independent space, not to watch too closely or looking over the shoulders of what other fund managers are doing.
Mm-hmm.
At the same time, I'm interested to hear what you think about sort of the inconsistencies in reporting methods and the information that's out there. There's been some horror stories that...
Look, to be honest, we do operate very independently, and I don't typically pay a lot of attention to what other fund managers are doing. Our portfolios look quite different than other fund managers. We do operate differently. We're based on the North Shore, so we're not seeing our competitors every day, so I do think we do things differently. I know there has been a lot of talk about inconsistencies with reporting. We've always just tried to follow the industry standard, and when you've got a unit price that's calculated independently of you every day, and that basically takes the value of your investments and divides it by the units on issue, and takes all the costs that have been incurred out, and you get a unit price. I just assume that every other fund manager does the same thing. And clearly they don't, and clearly there are moves in place to make sure that we're all absolutely consistent, and I'm very happy about that. I think for investors, ultimately they know how we've invested because that we send them a newsletter every month. They can call whenever they like, and they know that they've put $1,000 in, they know exactly what it's worth today, and so they know how they've made money. With Kiwisaver, their statements will say, this is how much you've put in, this is how much the government's put in, this is how much the employer's put in, this is how much of an investment return you've had, this is what your Kiwisaver balance is worth. So it needn't be very complex, and some of the talk I've heard, it sort of almost implies that all fund managers have been absolutely dastardly, and we've had all sorts of things there, but it's not that complex. There are not many things, generally not many elements to a Kiwisaver fund. They're the investments you make, they're the expenses you take out, and then you divide that by the number of units. So look, I applaud the fact that the industry is moving to more of a standard approach, and I think if that gives investors more comfort, then fantastic. Anything we can do to make investors more comfortable about Kiwisaver and saving generally is fantastic.
How much weight should one put on a performance benchmark? Because there's criticism that the existing benchmarks are quite meaningless because they're calculated on a lump sum basis instead of a weighted average, which is what the Kiwisaver model is. You're putting in money on a monthly basis.
Yes.
How does one accurately or objectively determine how their fund is doing?
Yeah, look, I think it is hard because all those tables that you see in the paper every week that compare unit prices. If it says that your Kiwisaver or a Kiwisaver fund is up 20% since Kiwisaver started, what that basically means is that first dollar you put in on day one is up 20%, but every single dollar you've put in since, and you've been putting money in every month, that's had a different return. So that 20% is somewhat meaningless. So it is a better indication of how you've performed is to look at the return of all of your investments. So that first dollar, that's gone up 20, the next dollar, whatever. And so I think we will be moving to that. I think the whole industry will be moving to that. And I know that from our Kiwisaver members, actual experience, even though we report a certain return in the papers every week, they've had a significantly higher return than that because, as prices were falling in 2008, they were buying more units as the price came down. And so then when the price recovered in 2009, they had more units to recover with, and therefore they've made more money than that first dollar invested on day one. But that's not reflected in the performance table. So it is hard, but at least the performance tables do compare everybody on a like-for-like basis. So even though it doesn't tell you your actual return, because you might have done a whole lot better than that, particularly in growth funds, at least it is comparing apples with apples so that we're all reporting on the same basis. So at least to compare how your provider's doing relative to someone else, look, it's a handy guide, but I wouldn't get hung up on it because that's not what you would have actually achieved in terms of your own growth if you've been putting money in regularly.
Okay. Any suggestions for people then what they should be putting more weight on in terms of, are they getting their money's worth in a Kiwisaver fund? Are they in the right fund?
Well, look, fees are important. There's no doubt about that, particularly with more conservative funds. If you're only earning a relatively low return, which you tend to do if you've got a low risk investment, then the difference between a 1% annual fee and a 2% annual fee is going to make a huge difference to your ultimate outcome. Less so for a growth fund, hopefully, if the growth fund manager does a good job. So I think that every member should look at their fees and just make sure that they're within the ballpark. You don't have to go for the lowest necessarily. You don't necessarily go for the highest. If you want to go for the highest, you just make sure that their returns are significantly higher than everybody else, so you're getting a decent return for the fees. So you just look at reasonableness of fees, and I think that's quite critical. I think communication is important because with Kiwisaver, your money is going to be invested for quite a long time. You can't touch it, and you want to know, even though you can't touch it, you want to know how it's being invested. And the more a fund manager communicates to you, the more you can feel comfortable that you understand what they're doing with your money and that it's consistent with what you want them to be doing with your money.
We've had one fund manager openly criticize the idea that a growth fund should necessarily warrant a higher fee, that he said, this particular individual said that all funds require the same amount of effort regardless of whether they're conservative or growth. You would beg to differ?
Well, don't tell me. He's not an active manager, right? Of course he criticised. Look, I do beg to differ. It's an age-old argument that you don't achieve any more from an actively managed fund than a passive fund, and a passive fund is just one that looks like the index. So you just basically buy all the stocks in an index, and so you will get the market return, no more, no less. It is age-old, and it's never really been answered, actually, because from time to time active managers have outperformed passive, and sometimes passive have outperformed active. I would argue that active is always worth paying a little bit more for, because I'm an active manager, and I know that over a number of years, having invested for 25 years, over a number of years I've outperformed the market by quite a significant margin, and so I think it's worth giving me a shot so that I can outperform rather than just achieving the market returns, particularly when you look at the New Zealand share market, for instance. Our share market index, is heavily skewed towards two companies, towards Fletcher Building and Telecom. Now that's fine if you want your portfolio to have predominantly a telecommunications company and a building company. But if you want more than that, if you want diversity across the whole economy, then you won't get that if you just construct a portfolio that looks just like the index. So I don't think it makes as much sense to have a passive fund that looks just like the New Zealand share market index, because the New Zealand share market index is flawed and skewed. So I think in the case of New Zealand, active management has certainly paid off. I know that we've outperformed the index over the last 10 years. So I think numbers speak for themselves, really.
Okay. Going forward, do you have any targets in mind for Kiwisaver for?
Look, I don't have any numbers in mind. What's important to fish funds, or to me actually, is that fish funds is well respected and well regarded as a fund manager. And if we keep achieving good returns, then I know that the money will come, that investors will want to join us. And so my target is to just be the best, or in that the top group of performers. I don't have to be number one. I like it, but as long as I'm in the top group of performers and investors have had a good experience in terms of their communication and client service on the way through, then I know that will encourage more investors. I mean, a large chunk of our members have come as a result of referral from existing clients, which I think is absolutely fantastic. So that's how I want the business to be. I think that Kiwisaver is going to grow, that there's no doubt about that, and the way that New Zealanders have embraced it already, I think that's really encouraging, and if we give them a good experience through giving them good investment returns, then more people will sign up, and so it should be a real growth industry. So as a fund manager, I'm very excited about where Kiwisaver is going. I want to be one of the best in terms of performance, best in terms of reputation, and that's what we're all working for, really.
Yeah, 40 years from now.
40 years from now.
What will Fisher Funds be looking like?
Well, look, hopefully not a hell of a lot different than it is today. I mean, we're 14 years old now, and which is a relatively short period of time, but that actually makes us we're quite a long-standing firm, actually, and certainly with our investment team, we've got an average of 25 years investment experience each. So, we are sort of long-standing industry players, and I expect that we will be. 40 years is, look, I am a long-term investor, and I do think 10 years out, but 40 years, I'm just not sure. But I've got some clever people here, and I know that they will, if I'm not here, and I might be, I hope I am. I don't have anything else I want to do, but if I'm not here, I know that the very capable people that I work with will keep the dream going.
Excellent. All right, Carmel Fisher, thank you for taking the time to talk to us. I'm Amanda Morale with interest.co.nz. This has been one of our double shot interviews. See you next time.